Wednesday, April 15th, 2026. Like and subscribe. The $1 Investor, DRAM Full Breakdown. 13th ETF, 13th day. Today I want to talk about DRAM, the Roundhill Memory ETF. This is my latest ETF purchase, and this one is different from the last few because this is not a Bitcoin wrapper, and it is not a cryptocurrency trust. This is an equity ETF focused on one narrow part of the semiconductor world, memory. Roundhill says DRAM began trading on April 2, 2026, carries a 0.65% gross expense ratio, and is actively managed rather than tied to a traditional passive index. What that means in plain English is simple. This fund is built around the companies that make the memory and storage muscle behind modern computing, especially the kind of computing artificial intelligence is leaning on right now. Roundhill said directly that memory is moving to the center of the AI ecosystem, and that broad chip funds do not give investors the same targeted exposure to that part of the stack. In other words, this ETF is not trying to own all semiconductors. It is trying to own the pressure point. That matters because memory is not some side story anymore. If AI keeps growing, memory becomes one of the toll roads. Training bigger models, running more inference, moving more data, and handling more bandwidth all put pressure on memory supply. Financial Content's market write-up said global DRAM revenue is forecast to surge by 51% year-over-year in 2026, driven largely by the shift to higher bandwidth memory and the needs of AI servers. Barron's also recently highlighted that Wall Street analysts remain bullish on memory demand because of AI growth and believe the market is still underestimating the earnings power of memory companies. Now let me get honest about history. This ETF itself does not have 5 years of history. It is brand new. So if I want to judge what it may do over the next 5 years, I have to study the theme under it. And that theme is memory semiconductors. That means companies like Micron, Samsung Electronics, and SK Hynix. Those are the names this fund is leaning on the heaviest. According to Roundhill's launch materials, the early holdings included roughly 24.99% in Samsung, 24.22% in SK Hynix, and 24.63% in Micron, with smaller weights in names like SanDisk, Kioxia, Western Digital, and Seagate. Morningstar's portfolio snapshot lines up with that concentration, with Micron, Samsung, and SK Hynix accounting for roughly 3/4 of the portfolio right out of the gate. That concentration is both the appeal and the danger. The appeal is that if memory names run hard, this ETF can move with force. The danger is that this is not broad diversification. This is a focused shot. ETF.com called DRAM one of the smartest launches of the year and reported that it pulled in about $181 million in its first week. The same publication and other launch coverage emphasized that it is the first purely memory-focused ETF, with only a small handful of stocks and a very top-heavy structure. That tells me Wall Street understands exactly what this product is. This is not a sleepy retirement fund. This is a thematic weapon. So what does Wall Street think? Right now, the early take seems to be that the fund is well-timed. The memory trade has become one of the cleaner ways to play AI infrastructure without simply buying every chip name under the sun. ETF.com and the Daily Upside both framed the fund as a highly targeted way to capture a market segment broad semiconductor funds tend to dilute. The street is not looking at DRAM as a core market replacement. It is being viewed as a focused bet on one of the hottest bottlenecks in the tech build-out. And what are analysts saying today? The analysts are not really talking about DRAM itself yet because it is too new. What they are talking about is the underlying group. The tone there has been bullish. Barron's reported that Bernstein's Mark Newman and Cantor Fitzgerald's C.J. Muse both raised targets on SanDisk and argued that strong memory demand could last through at least mid-2028. The thesis behind that kind of view is straightforward. More AI demand means more memory demand, and more memory demand can mean stronger pricing and earnings for the companies this ETF owns. Now let me talk about what this thing is doing in the market so far. The current finance feed shows DRAM around $34.75, with an intraday volume of about 5,998,606 shares. Stock analysis showed a recent range up to about $34.79 and noted the fund launched on April 2, 2026. That tells me this thing has already attracted real trading interest for something this new. Now let me bring it back home to my own position, because that is what I do on this channel. According to my screenshot, I own 0.030911 shares. My market value is $1.07. My average cost is $32.35. My portfolio diversity here is 0.03%. My return for the day is positive $0.0367 or positive 3.53%. My total return is positive $0.0737 or positive 7.37%. And my recurring investment is $1 every single day. That right there tells the whole story of how I move. I do not need to come in big to begin building. I do not need permission to start. I do not need thousands of dollars sitting around to make a move. I build the same way I have been preaching for years, $1 at a time, with intention, with patience, and with a willingness to let time do the lifting. Now let's talk about the next 5 years, because that is the real question. The first road is the bullish road. In that world, AI demand keeps scaling, memory stays tight, and the biggest players in DRAM and NAND keep benefiting from stronger pricing and rising margins. If that happens, this ETF has the kind of concentrated exposure that can move hard because it is so heavily tied to the leaders. The whole reason Roundhill launched this product is because they see memory as one of the central pressure points in the next phase of AI infrastructure. If they are right, this could be one of those niche funds that looks small at launch and powerful in hindsight. The second road is the middle road. In that world, AI still matters, memory still matters, but this remains a cyclical industry. That means periods of euphoria, then oversupply, then corrections, then recovery. This is the part people forget. Memory is not a straight-line business. It is one of the more cyclical parts of tech. So even if the long-term story stays alive, the ride can still get ugly in between. That is why I would never talk about this like it is some guaranteed winner. It is a focused bet on a powerful theme, but it is still a cyclical one. The third road is the bearish road. In that world, memory demand cools off, AI spending slows, hyperscalers optimize usage faster than expected, and pricing power fades. If that happens, a concentrated ETF like this could feel it fast because it does not have much room to hide. With only a small number of holdings and huge weight in the top 3, if the leaders stumble, the ETF stumbles. That is the trade. The same concentration that can help you on the upside can also hurt you on the downside. So my bottom line is simple. DRAM is not trying to be everything. It is trying to be precise. It is a narrow, concentrated bet on the memory layer of the semiconductor business at a time when AI is making memory more important, not less. Wall Street seems to like the timing. Analysts like the underlying companies because of the memory cycle and AI demand. But none of that removes the risk. This is a focused, high-conviction thematic ETF, not a broad market safety blanket. For me, this is not one of my giant foundation positions. This is one of those newer, sharper tools I am adding to the box. It fits my system because I can build it slowly, I can control the size, I can stay disciplined, and if the memory story becomes one of the biggest AI stories of the next 5 years, then this $1 a day could turn into something a lot bigger than it looks right now. 5 to 10 minute video breakdown script, like and subscribe. The $1 Investor. Today I want to talk about DRAM, the Roundhill Memory ETF. This is my newest ETF. And this one is different. This is not crypto. This is not a broad market fund. This is not one of those everywhere at once ETFs. This one is a focused shot. DRAM is built around memory, the memory side of semiconductors, the part of the tech world that artificial intelligence cannot keep scaling without. Roundhill launched this fund in early April of 2026, and they launched it with a clear message. Memory is becoming one of the most important choke points in the AI build-out. That got my attention because I am always looking for where the pressure really is. Not the hype, not the noise, the pressure point. And right now, memory looks like one of those pressure points. Now let me explain this in plain English. When people talk about semiconductors, most people think all chip companies are the same. They are not. This ETF is not trying to own everything. It is trying to own the companies that make the memory and storage backbone that modern computing runs on. That means names like Micron, Samsung Electronics, SK Hynix, and a handful of other companies tied to memory and storage. So this is not broad diversification. This is concentration. And concentration cuts both ways. If this theme works, it can work fast. If this theme cools off, it can get hit fast too. That is the truth. Roundhill says this fund is actively managed, and the expense ratio is 0.65%. So you are paying for a targeted product, not some plain vanilla index fund. That tells me right away this is not meant to be boring. This is meant to be deliberate. Now let's talk about why Wall Street cares. Wall Street cares because AI is making memory matter more. The bigger the models get, the more bandwidth they need. The more data centers grow, the more memory matters. The more inference expands, the more pressure gets put on this layer of the stack. That is why Roundhill launched this product now. They are not guessing. They are following where demand is building. And early money noticed. ETF.com said this fund pulled in about $181 million in its first week. That is not small interest. That is real attention. Now let's talk about the structure. This thing is top-heavy. The top 3 names make up about 3/4 of the fund: Micron, Samsung, SK Hynix. That means this ETF is not hiding what it is making a direct statement. If memory leaders win, this fund has a shot to win big. If they struggle, this fund will feel it. Now, what are analysts saying? The ETF itself is too new to have some long trail of traditional ETF analyst calls, but the companies under it are getting real attention. Wall Street analysts have been turning more bullish on memory because of AI demand. Some of them think the market is still underestimating how long this memory cycle can run. That is important, because if the cycle stays strong, this ETF could ride that strength. Now let me bring it back to my own position. According to my screenshot, I own 0.030911 shares. My market value is $1.07. My average cost is $32.35. My portfolio diversity here is 0.03%. My return for the day is positive $0.0367, or positive 3.53%. My total return is positive $0.0737, or positive 7.37%. And my recurring investment is $1 every single day. That is how I start. I do not wait around for the perfect entry. I do not need a pile of money to begin. I just start. $1 a day, every day, no excuses. Now let's talk about the next 5 years. I see 3 roads. Road number 1 is the bullish road. AI keeps expanding. Memory demand keeps rising. The top companies in this fund keep winning. And DRAM becomes one of those niche ETFs that looks smarter and smarter with time. Road number 2 is the middle road. The long-term memory story stays alive, but the industry stays cyclical. That means rallies, then drops, then oversupply, then recovery. In that world, this ETF still has value, but the ride is rough. Road number 3 is the bearish road. AI spending cools off. Memory demand softens. Pricing power fades. And this concentrated fund feels it hard. That is what people need to understand. This is not a safe little side fund. This is a sharp tool. And sharp tools require discipline. So my conclusion is simple. DRAM is a direct bet on the memory side of the AI story. Wall Street likes the timing. Analysts like the underlying memory names. But because this thing is concentrated, it comes with real risk. For me, that is fine. Because I build slow, I control position size, I stay disciplined, and I give time a chance to do what time does best. Like and subscribe, The $1 Investor.